lot of you will look at your portfolios at the end of today and it'll bring a smile to your face. Today more than anything else, and that's because the positivity that has come about after the signing of the US-India trade deal has flowed through into equity markets. But what learnings can you take from the last year and a half or so, and how should you adjust your portfolio strategy so that you can get the most of the rally that is expected to pan out over the next several months? I'm joined today by Mohit Gang, who's a co-founder and chief executive officer of Moneyfront. Mohit, thanks as always for taking the time. First, I'm sure that a lot of people might have called you or you've spoken to some of your clients. What is the message that you're giving them today?
Oh, I think the message is there for everyone to take, Alex. Thank you so much for having me out here. And it's written on the walls that if you sit patiently, you wait for the opportune moment, there is enough and more money to be made in the markets. And if you are the one who gets perturbed with every moment of the market, has the itch to keep changing your asset allocation, has the itch to keep flipping your funds, keep redeeming out of it in bad cycles, and keep entering in when you think everything's going fine, I think you're not the one who will make money. So this is a timeless lesson which the markets have given to all of us. For last 18 months, we haven't done anything. We've just been in a tight range, some minor ups and downs, and nothing much. And today, suddenly, with just one flash of a news, we don't even have time to enter the markets now. So this is classic markets, Alex.
Yeah, you know, I was looking at it. 7th of August last year was when the initial 25% tariffs came into play. And 27th of August was when that penalty of 25% additional tariffs came into play. And the Nifty 50, as of close on the 6th of August, as of yesterday, the difference was that the Nifty 50 was up 2.1% from that point. And the broader markets were actually, the mid-cap index was down 2%, the small-cap index was down as much as 10%. Quite a bit of that has changed quite dramatically. Now we've gone above, once again, that level that we were on the 6th of August. But the portfolios that a lot of people had constructed, Mohit, had tended towards the small cap funds, right, at the start of 2025. And those have likely changed over the course of 2025 and heading into 2026. Do you think that's the case?
Oh, absolutely, Alex. I think on the back of a great 23 and 24, I think every investor and their relatives and their neighbors and everyone kind of got extremely overconfident in the market, heavily loaded their portfolios towards mid and small caps, heavily loaded towards micro caps, unknown names. And they were rewarded for a long while till 2024. And suddenly the script changed in 2025, and small caps were the worst performing bet on the street, as you rightly mentioned. And since then, they've never seen light of the day. Honestly, I think, again, as I said, timeless lessons in investing, that you cannot get overconfident and over dependent on any single asset class. And you cannot be just going by the past returns always and thinking that same will continue in future. Heavily load yourselves into one particular segment or one particular market cap or one particular sector, right? So small caps still continue even today, even after the news today, Alex. I think small caps are under some kind of pressure just because the valuations have become extremely frothy, right? And again, last year, if you compare, large caps were the ones which gave investors at least some somber returns in an otherwise very despair kind of a situation, right? So if you were clutching onto the right stocks, if you had the asset allocation right, if you were having some amount of allocations towards large caps, the flexi caps, then you had a decent going even in 2025, and you weren't like heavily disappointed. But otherwise, it's not the case.
Okay, so let's talk about what you should do from this point on, because Mohit, the tendency in a underperforming scenario is to stop or redeem. And for those people that I think continued to invest through a systematic route, even if it is in small caps, they will at some point get the benefit of that because they've been averaging or they've been buying when the unit cost is low. So a lot of people will actually see a quantum shift in their earnings, even if we see a 5 to 7% or 10% increase from this point on. So how would you construct your portfolio right now?
Oh, absolutely, Alex. Look, again, if you had been patient with your portfolio and actually were following the right allocation strategy, which means that your SIPs continued to go through the course of 2025, whether it be in large caps, mid caps, small caps, depending on how your portfolio was shaped, then obviously you have accumulated a lot of units over this period of time. And now's the time those accumulated units will start rewarding you. Some portion today and maybe coming future months, I think, given at the backdrop of the EU deal and the US deal both happening. And then perhaps by the second half of this year, you should start looking at good corporate earnings also coming back. And the last year's base effect will also kick in. So you will have reasonable numbers this year, right? So the investors and their patience will get rewarded. What should one do now? The second part of your question. Look, I think I would still stick by my asset allocation strategy. As an investor today, I would like to put 80% of my portfolio into core strategic assets, which are long term in nature, which are meant for my long term financial goals and needs, like my retirement or some 10-15 year kind of goals. The second portion, which is my tactical portion, will be 20%. It could be a little lesser for less aggressive people, but that's more for quicker plays and quicker checks in, check in and check out. But on the strategic part, which is the most crucial part of your portfolio, I would still be largely onto large caps, flexi caps, and large and mid cap category. So almost 50% of my portfolio I'll put in that bucket, around 20 odd percent in mid caps, some 10% international allocation, can swing by 5% plus minus. Some 10% commodities can go up to 15, can swing by 5-10%, 5 odd percent plus minus, and maybe a little bit of 5 to 10% small caps. Still not very heavily going into small caps. The market setup has to convincingly be extremely rich on valuations, less frothy, and convincingly into a very good happy territory for one to take a larger allocation bet into small caps. And even from a very long term perspective, I think having small caps limited to around 10-15% odd maximum in a portfolio is a very good way to manage and construct a long term portfolio.
Okay, so this is very interesting. We are heading into the last leg of the financial year as well. And as they usually say, from a tax standpoint as well, this is a great opportunity for you to correct problems in your portfolio. If you need to rebalance, for example, and if, for example, hypothetically, you've got an overweight on small caps, which you shouldn't have, and if there is loss that you're seeing in that portfolio, you can just book that out and you can set that off against future profit. So this is a great opportunity for you to consider doing that. But I want to ask you within this, and I know that you're a proponent of passive also as a strategy. So out of all of this, where would the passive strategies come into play? And is there room for a multi-asset fund? Because there are people who've taken that commodity allocation and they've said they don't want to take that decision themselves. They want to ask the fund manager to do it. And so they've done it through that route. So where does the multi-asset fit in this portfolio?
The first part, Alex, on the passive side, passives predominantly will form the large cap portion of your portfolio. In the large cap bucket is where I would place my passives. The second placement of passives could be in the international bucket, because there again, I believe that it's very difficult to track so many markets globally. So it's better to have a basket of ETFs or an index based route, right? And the other portion could be purely active. Now, the second part of your question, which was more related to, sorry, could you just repeat the second part, Alex? Multi-asset, yeah. So look, I think it's fantastic to have a multi-asset product in your portfolio if you really don't want to haggle too much between your commodities allocation, your fixed income allocation, your international allocation, so on and so forth, because these are smaller allocations and many a times we get confused as to what to increase and what to decrease in our portfolio. So leaving it to the choice of a dependent fund manager who's professionally qualified and doing this day in and day out, I think it's a fantastic choice. So yes, for investors who don't want to be active enough to take those bold calls, it's good to be lazy and have a multi-asset allocation in the portfolio. So you can combine your commodities, international, some portion of REIT InvIT, even fixed income by a large extent through a single multi-asset window. And I honestly think genuinely that's a great product in any kind of a portfolio unless you are savvy enough, or unless you have advisors who are like really confident to be dealing across all market caps and across all sectoral themes independently. I
Yeah.
think otherwise multi-asset is a good choice.
I was speaking to somebody just yesterday, and that person was saying that in this kind of scenario, having a higher commodity exposure is not a bad deal. But the advocation was for gold and not for silver. Do you agree or concur?
Oh, absolutely, Alex. In fact, I have a very bold blog which I rolled out around 10-15 days back, saying that we are a bit bearish on silver relatively, and we are structurally bullish on gold. Right. So yes, I continue to believe that for multiple reasons, gold is a revolt against the system. It's a revolt against the U.S. hegemony, against the dollar as a concept of a singular petrodollar currency of the world. It's a revolt against a lot of geopolitical events which are happening, right? And central bank demand is much more steady, much more stable. The supply of gold isn't so abundant. It's not easily replenishable. And for 5,000 years of human history, gold has withstood all kinds of pressures and still stands tall as a currency and as a store of value.
Yeah.
Right. So I'm structurally very bullish given the way the global setup is. So gold, yes, it's a bullish call, relatively.
Fair point. All right. Well, that's how you should line up your portfolio strategy. And if there are excesses, this is the moment to correct them. Mohit, thanks so much for taking the time. Pleasure speaking with you.
Thank you so much, Alex.
And that brings us to the end of this edition of Your Money Matters. Thanks so much for watching, and do stay tuned. This is NDTV Profit.